All right, so what important detail do I think that a lot of traders and investors are overlooking right now, especially traders and investors whose first time as a market participant is through the crypto markets? So let's get to that in a second. What's going on, guys? This is Ryan, aka Cantor and Clark. And on behalf of my partner, Josh Rigger, and I just want to thank you for tuning in to the BlockRoots YouTube channel. If you're not already a subscriber, make sure that you go ahead and click that subscribe button. So each week we actually give away hundreds of dollars worth of Bitcoin, and this video, like most of the others, will be no different. So that being said, we're going to get into a few different things in this video. So we're going to talk about where we currently are, just some ideas that I think are worth paying attention to, especially during a time of uncertainty when prices ranging after a higher time frame move like we've had, some of the things that we could look to. Then I'm going to get to what I talked about in the beginning of the video, something that I think that a lot of people are leaving out. And it's no fault to them. For a lot of traders and investors in crypto, this is their first time in any market. And this is not something that if you've come in post 2017, you would have been trading within, or trading during rather. And then lastly, you're going to talk about how this also affects the crypto markets. Okay, so this particular detail that I think is overlooked and how this can affect the crypto markets and sort of what we can do or how we can prepare to deal with this type of situation. All right, so before we get into the meat of the video, I just want to take some time to highlight the new feature that's available on Phemex. And all of you know that Josh, myself, BlockRoots as a whole are partners with Phemex. So we're partners for a reason. We think that it's the most incredible spot and derivatives exchange that's out there right now. So not only do they offer spot and contracts, but they offer a subscription-based fee model on spot. So that means that for less than 2 cups of coffee a month, you can trade spot crypto assets with 0 fees. And that might not be a strong selling point to you right away. It seems rather non-obvious, but if you've been trading for a long time, you'll realize that your transaction costs can tremendously eat into your bottom line. So the fact that you could trade in and out of spot, especially during a time like this where there's a high level of uncertainty and you're trying to constantly protect yourself and get back into some USDT or USD, the fact that you could trade without fees and do this is absolutely incredible. So Phemex is by far, in our opinion, the most dominant exchange out there right now, especially offering contract trading just because of the incredible speed that they have. So 300,000 transactions per second. You don't have to worry during times of heightened volatility. When I'm scalping in and out of positions, the fact that I could just mark it in and mark it out without any issue whatsoever, and now the liquidity is there, it's a no-brainer. So one thing that they've gone ahead and offered as of the past week is their bracket order feature. So the bracket order essentially allows you to not only set your order up the way that you should from the outset with 0 friction, you have your stop loss and your take profit set up immediately before the trade's placed. It allows you to act as a market maker. So this is an algo that allows you to take opposing positions, multiple opposing positions. So let's say that, for example, price has been stuck within this range for the last 5-6 days. We could have essentially mapped an idea of the range, what kind of trading environment we were in, and the volatility we could expect, the price range that we could expect. And we could have essentially acted as a market maker during this period by providing asks and bids, all set up with stop losses and take profits. And you're going to do this by actually selecting the bracket order setup by tick size. So on Phemex, 1 tick is 50 cents. So if you're looking to capture, $20 worth of profit, it's 40 ticks. And you're essentially going to be trying to capture the spread back and forth between buyers and sellers. So you're going to be providing resting liquidity and receiving as compensation that 2.5 basis point maker rebate. So you could make money when times are just choppy and crap to trade directionally. So what you go ahead and do, you could pick your tick size. So we'll just say we're going to pick a $10 profit size, right? And we're using a limit order for this. So as long as it executes based on limit, you're not going to have to worry about slippage. Okay, we're going to use a stop loss. In this case, we'll leave it on a limit as well. You could do a market if you want. And we'll say that this is a 10 tick size. So the trade is 2-to-1. Right away, you set up a 2-to-1 trade, $10 profit, $5 stop loss, and now you have your bracket order set up. So we could go ahead and we could just pick areas on the order book to immediately sell. So now we have an order right there. We're going to move these up a little bit more so we could see them. So we'll actually go down to the 3-minute time frame, so it's a little bit more obvious. So we're going to go ahead and sell some more, pick up some more orders over here, and these are all set up with your take profit and your stop loss. And now, since we're going to be providing offers and asks and bids, offers or asks, depending on what you want to refer to them as, we're going to go ahead and do the same underneath price. So hopefully what we're going to be able to do is capture that maker rebate for essentially acting as a market maker on the exchange, providing resting liquidity. So you're going to be using passive execution, collecting that 2.5 basis point maker rebate, and you're immediately set up with your take profit and your stop loss. And it's an OCO order, so it's one cancels the other. So if your stop loss is hit, your take profit is taken off the book. You don't have to worry about it inadvertently, opening up a new position. So these aren't going to affect each other either. My suggestion is just to keep your strategies separate and everything sort of compartmentalized and I guess properly categorized, is to open a sub account. So I have multiple sub accounts, and you could just open a sub account and essentially for when times are choppy or ranging, go ahead and just use the bracket order market feature, or excuse me, bracket order template. So again, just pick your orders and you could have, $5 take profit and just try to capture the spread and ping a bunch of these orders around price. And if they fail, they fail. But you'll see that they'll execute rather quickly, and it allows you to get in and out of trades in a very effective manner. So that being said, let's get to the meat of this video. All right, so let's talk about where we currently are. And let's keep it simple as well. So we broke above the 2019 weekly closing highs. So if we look at the weekly chart, we exceeded the last peak. All right. This has broken through a major contextual level that served as resistance since then. So this shouldn't be something that requires too much thought to tag a position on. Okay, this is definitely not something that I'm going to be adding any kind of high leverage positions to, but the market is in a place where it's really easy to define risk. And for position trades, for higher time frame swing trades, even for adding to investments, this represents a buying opportunity. And of course, all things can change. Of course, there is, no such thing as being 100% certain. But if I was in a position where someone put a gun to my head and said, do you think this is a long or is it a short? I would say that I think it's a long. Now, we're going to look a bit more into just where we currently sit from, again, a contextual risk reward standpoint. And we're going to look at some things that I think are worth paying attention to. But if you look at this chart on the high time frame, the areas where we were rejected multiple times previously, this is the first return to that. So this is an impulsive return. So it's a move with high conviction. But a lot of the times, the moves that end up rebounding the most are moves that approach a level from a distance with a high level of velocity. So you get a lot of people scared. You get a lot of people anticipating, continuation of this trend. But I think the most important thing to pay attention to is this is the buying opportunity that many people were speaking about before it even came. But that always happens, right? It's always looked to in advance a level, and when we break through this level and come back to treat it as support, we're all going to buy it, right? But when push comes to shove, not everyone is willing to ante up, okay? So after this first break, initially you wouldn't want to see that we immediately came back and tested it, okay? In a strong trend, you're going to get a very shallow retrace. All right, so after this big move, we talked about a retrace that might not even go down to the 0.318 fib, okay? But after the move has transpired, after we've consolidated for some time, a lot of the times in this market, there's a lot of leverage, right? There's a lot of leverage products that are available. And because of this, it gets a little heavy with that regard, okay? So you have to unwind some of that leverage exposure, okay? Especially some of that late exposure. And this is things, or rather these are things that we go over in BlockRoots all the time. The idea of trap positioning, trap traders, when one side is off sides. So, at the top of a move, you're going to have that. You're going to have traders that are buying late, and when price pushes against them and hits their pain point, they will voluntarily or involuntarily be forced to sell, either through marketing out or their stops being hit. And when you have multiple stops in a given area, you get sort of this cascade effect where you have one large candle to the downside. Right? Same thing works to the upside when a lot of people are betting on continuation to the downside. You get a very big squeeze to the upside, one of those $500 to $1,000 candles. So for me, this represents an area where we could really easily define risk. So it makes sense for me to put on a position, okay? To begin scaling into more of a spot position, more of a position trade, which is just a longer term, sort of gray area between a swing trade and an investment. So it's a great area because we could really define risk in a very obvious way. This is, again, an area that served as resistance multiple times over. It should serve as support right now. If we're to fall back within this range and start testing the lows of this range, well, maybe the idea is wrong. If we start breaking below the low of that range, well, then the idea is probably definitely wrong. Okay, so this is in an area or approaching an area. It might not necessarily turn right here. You might get something like this, right? A dip back down a little bit to provoke a little bit of fear and then a rip up. But it's in an area where you could really define your bias, right? Market structure is still being respected. In crypto, it's a little loose because, again, it's not as liquid as legacy assets or some legacy assets. So this is in a good area, I think. And it's sort of in one of those textbook areas where it makes sense to add, right? Now, that being said, again, nothing is 100% certain. There are times when you have a big move down like this, and then the market is going to range for a long period of time. And during ranges, that's when people look to maybe find hints in other information, right? They try to play the whole detective within the market. Now, I wouldn't really overcomplicate this. What I want to see are certain signs on the higher time frame that sellers are really taking this a step up. Okay, they're anticipating continuation and they're positioning in anticipation of that. So what we would like to look at that point, or what we should look at, are things like futures term structure, option skew, open interest, okay, and then seeing, whether or not there's consistent spot premium or spot discount. So ideally what I want to see after a big move down like this, okay, big move down like this that clears a ton of open interest. So if we look at the open interest, it took quite a haircut recently and it hasn't really recovered yet. All right, we'll get into what I think that means. But after a move like this, okay, what I want to see is that sellers are still getting aggressive. So ideally what I would want to see is that the spot price maintains a premium over the futures price. Now what that means is essentially, if we look at the order book, just to oversimplify this, here we have Binance spot, Coinbase spot, OKX spot, and then we have BitMEX futures and Binance futures. So what we would want to look for is that traders are still getting aggressive on the derivatives platforms, because that's where you're going to build up open interest. That's where you're going to capture that potential involuntary buying power, right? Where traders are trapped. So what we would want to look for is where the spot, or cases of where we're moving sideways and sentiment is negative, and the spot prices, these prices right here, are maintaining a premium over the futures prices. So what that means is that the futures prices are trading below the spot price. So you can see right now it's about $4 or $5 difference between Coinbase, but this over a long period of time, this type of basis is a good sign that traders on the futures exchanges are still aggressively getting in position to the downside. So you could also look at something like skew, and you could also look at something like futures term structure. So futures term structure, as you can see, all right, this is the annualized basis. So that is the annualized percentage difference, okay, across the term structure, across expirations. But what you see is that the futures term structure has pretty much flattened a lot recently. All right. So what that means is that the future prices on the forward contracts, further out, talking December, March, those were recently trading right around the current spot price. So normally we should see this sort of progression from low to high where the market's in contango, right? Market's optimistic. And in the case of them being relatively flat, all right, where the futures prices, the further out expirations, are trading close to the spot, or even in backwardation where they're below, that's a really good indication that the market is not really optimistic about the future, right? It's selling those futures contracts. Okay, it's selling in anticipation that the price is going to be lower in the future, and it's taking advantage of a trading vehicle that doesn't have something like the funding. So it's a better tool to use for longer term positioning, whereas perpetual swaps are better for short term trades. So what we've seen recently is that we actually have a sign of that. We have the futures term structure begin to compress. Now, normally you'll see that in a really strong trend, this could be upwards of 6 to 10%. So meaning the forward contracts might be 6 to 10% higher than the spot price. All right. Now it's actually really low right now. So it's gotten down to almost being relatively flat, or almost being flat in general, excuse me. But right now the furthest out contract is trading around $2, it's trading around 2.2%, right? So 220 basis points above these current contracts. Now, another thing we could look at is the option skew. So 25 delta skew shows us the difference between implied volatility of the 25 delta put and 25 delta call. So it gives us an idea of which one is trading more expensively. So when puts are trading relatively more expensive than calls, okay, and the market has a preference for puts, it just shows you where the market is placing fear, okay? And when we have it, that this is the case, okay, as you can see, this value right now, the short-term skew, okay, is right here. That is in an area that shows you that the market is pessimistic, okay? What it could mean is that, you know, you have options writers and dealers that are selling calls that are not anticipating those to expire in the money. So they're not anticipating higher prices. And you have a lot more bidding of the puts, right, at that 25 delta. So it shows you where the market is anticipating, you know, it being, or where participants are anticipating the market will be in the near future, which this is not something that you're just going to look at on its own and say, okay, that means that it's predictive and the market has to move down. It's a gauge of sentiment, right? This is, options become very complicated. I don't want to get too far into it on a BlockRoots YouTube, but it is a good sentiment gauge, right? Especially when we see it spikes to very high values in the short term. So between this and futures term structure, as well as looking at something like basis, so we can actually we'll go ahead and take away, and not sure why the on-balance volume was there. For some reason, my trading view keeps pulling up different things that I haven't used in a really long time. So we're looking at, this is the neobutane funding and premium index indicator. I'm not so much interested in the funding, but what I'm interested in is this basis. So what these values below zero are showing us, okay, the yellow right here, is that the futures on BitMEX were trading at a discount to the spot price consistently over the course of this range. So what that is saying again is that on the derivatives exchanges, there's an excess amount of selling. And if you look at this, it hasn't resolved really in any kind of lower prices. So just think about these wicks down here as sellers getting trapped. Okay, sellers getting trapped is what we need to fuel a move upward. Now, another thing we could look at is the actual open interest. So open interest has not actually gone up much, except for when the prices move down. So if we look at this on scalp decks on the lower time frame, you could actually see that the periods where price moved down, so this is another tool to use, especially when we're sort of in this choppy range, the periods where price moved down, that's actually where we had open interest go up. Okay, as a whole, open interest took a haircut from where it most recently was, right? So what this means to me and how I interpret it is that sellers, again, are opening up new positions. That it's not necessarily the longs, even though there's one buyer for every seller. It's not necessarily the aggressive longs that are getting into position, it's the aggressive sellers. So if aggressive longs are getting into position, and we saw that open interest was increasing with longs, you know, then I might be inclined to say that longs are more likely to still get squeezed. But the thing about the low open interest relative to where we currently are, I think that we have a market that is fairly uncertain, right? That the market is, you know, doesn't know where price is going to be in the near future. And you have a lot of people that are hesitant to get into any kind of derivative exposure. Now, what this really likely means is that as price moves up, these people will come off the sidelines. So they're just sitting in the sidelines right now, uncertain. But mark my words, they will chase price up. Okay, that's the herding behavior and momentum effect that we see, where buyers are sort of, you know, reticent to get it back into the trend, or once buyers, and their delayed response to the trend actually taking place, meaning moving back up, their delayed actions, meaning they didn't get in early, are what help fuel the momentum upward. And at that point, anyone who got in to these aggressive positions to the downside that increase open interest, if we could best say that they might be aggressive shorts getting trapped, anyone who did that is going to get squeezed and help this move upward. So that is something that I think is invaluable to pay attention to. And if we get further into it and we go into something like cumulative volume delta, which we go over on BlockRoots, you can see that it has been moving down as price has remained relatively stable within this range. So it's just more of an idea that sellers have been getting off sides, right? And buyers are going to be shifting back into control, or having control. So right now you see we're trading right back above our weekly and our one-day VWAPs. These are all pretty positive signs. And I will say that this, coupled with the fact that ETH has even more extreme values in backwardation, okay, in this futures premium and discount, coupled with the fact that ETH has been leading, is a really good sign. So I don't think that, you know, this means that we're definitely going to move up right from here, but I think that this general area, that there's not much long exposure to squeeze out. So even if we broke down to 9,600, I think that this is all representing just a dip. It's the first real shakeout in a very bullish trend. So that being said, I wouldn't let things, scare you out of position if you have a good position right now. I am not, advocating buying any highs, but I do think that, this general area is just going to be a blip in what is trend resumption, hopefully within the next month. But that brings us to our next point. So it's always important to know where you sit within the day, within the year, with regards to any kind of major fundamental developments, any kind of major secular changes. And for the intraday trader, they might look at something like this, right? They might look at something like, your time of day volume, activity periods that are high and low throughout the week. You have Tuesdays, Wednesdays, Thursdays that are typically higher in volume and offer tighter bid-ask spreads. And then you have, times of the day that are favorable to trade. So this is more for the short term though, right? So from the period of 6 UTC to 12 UTC, we see that volumes pick up considerably. Okay, and you could use this to add to your statistical modeling with regards to any kind of trading setups, right? You don't want to trade the weekends more often than not. They're choppy, they're illiquid, right? There's not much volume that takes place. Now, this might change, right? Because crypto is a 24-hour market. It's not like legacy markets, but what we are seeing is that it's in some ways actually behaving like a legacy asset, okay, with regards to it being thinner and on lower volume on the weekend. Now, that's more for the intraday, all right? You should always have an idea of where you sit within the year as well. And that brings us to the month of September. Now, the month of September is crap, for lack of better words. The only other month that's worse than September is March. So that being said, that puts this correction in a bit of context. So the month of September is not one that is really favorable for trading Bitcoin. It is on average one of the poorer performing months throughout the year. And it's actually the second most poor performing month throughout the year, again, when you consider March, which is, I think it's a lot worse than September. But, we don't have to think much because the chart is right here. So that's the month of September on any given year. But this September falls within an election year. And this is really important, right? So we always have to keep in mind where we sit in the trading environment, okay? Or what's going on within the trading environment, within the larger global macro environment. So that brings me to the point about the election, okay? Pulled up the wrong computer screen. So with regards to the election, we could expect some volatility. So you could actually see this when you're looking at the VIX futures term structure. Now the VIX is based on the S&P 500 index call options. Okay, so this is going to give us an idea of how much volatility the market expects. So we could actually see going all the way to next year's expirations that the market is still anticipating volatility. Now, this is probably due to the fact that a lot of people anticipate that the election will be contested either way, right? So the market is expecting volatility. Now, you should always know what's going on now at this point in traditional markets because we've seen that traditional markets and crypto assets have been so correlated, which brings me to the next point. What kind of nominee, whether it's a Republican or a Democrat, how the market is rather going to feel about whatever kind of nominee we get. All right, so if a Republican is nominated, so if we have a Republican in office in the United States next year, the market typically looks at Republicans as, favorable for a strong dollar. Okay, so you have to keep that in mind because Bitcoin has been correlated to the DXY recently. So if we have a really strong dollar, we've seen that Bitcoin and the dollar have had an inverse relationship. Whereas with the Democrats, the market has looked at a Democrat president as sort of a sign for a weaker dollar or bringing upon a weaker dollar, rather. So these are really important things to pay attention to. We're in an election cycle. We're in an election year. This is something, and I said in the beginning of the video, something that I think a lot of people are overlooking. And, it's to no fault of their own. There's a lot of people that came into crypto after 2017, right, who have not experienced any kind of presidential election and the type of volatility that brings. So, it doesn't always bring volatility, but the type of volatility that this one seems to rather anticipate. Okay, so just looking at VIX futures term structure, we get an idea of that because you can see going all the way out to January that the VIX is trading above 28. All right, and anywhere between 12 and 20 is more or less going to be where you find most of your value, so on average. But above 20 is considered high. So at 28, that's pretty high compared to the norms, right? So this is something that I think is unique to trading Bitcoin right now, especially when you consider that we've seen the whole Bitcoin, equities, gold, DXY correlations. And it sounds funny to say all of those because some of those are inversely correlated on their own. But it has on and off had this sort of fickle relationship between all of those assets. Right now, what it seems to have is an inverse correlation to the DXY, so it has a positive correlation to gold. And that seems to be enforced on a higher frequency level. So it's not just that we see that enforced by retail traders. It appears to be that there are probably some larger funds that are playing this trade and playing this relationship. So that being said, I think that this is something that's really worth paying attention to. You can't trade crypto as if it is all crypto-based internals right now that are factoring into what's going on. Okay, you have to understand that it's actually become more of a macro asset. This might not be something that is as obvious on some of the altcoins, but make no mistake, when Bitcoin moves drastically, it's just going to turn those altcoins into, as we said in the newsletter recently, your higher beta play. And for those of you that are not familiar, we put out an incredible newsletter. So each week we put out BlockRoots Crypto Market Insights. And this offers a higher time frame macro view of the digital asset space. And we do this once a week as a higher time frame look, and then periodically throughout the week we give updates with the trades we're taking. And this is a phenomenal newsletter. For $9.95 a month, as I always say, for less than 2 expensive coffees a month, you get a tremendous amount of value. I think that if I'm lowballing it, and I know for a fact that I'm lowballing it, that the trades we've taken and the trades we've shared as taken, that we're setting up, the ideas, the opportunities, they've net over 1,000% returns in the last month and a half. So take a look at the free one we put out. I don't think that anyone else puts out a newsletter like this. And this is not something where we're just sharing other articles that people wrote. This is something that we've put together where we're taking a high time frame look at the market. We're looking at traditional markets. We're looking at futures term structure, all the things that we briefly went over. We're talking about things like short gamma theory, which is something that has applied recently with regards to the equity sell-off. We take a look at options skew. We look at everything that is really important with regards to the higher time frame. And again, we also share our lower time frame trade ideas, which have worked out to be quite favorable. So check it out at blockroots.substack.com. All right, so time for the lottery. So we're going to give out $100 in Bitcoin to a lucky commenter from the video that Josh did yesterday. So we're going to go ahead and get these comments. Loading, loading, loading. A lot of comments. Wow. And then pick it. Random raffle. And the winner is this week. Hopefully I time it right. Mason Baker. That's an easy one to say. So congratulations, Mason Baker. You have just won $100 in BTC. Go ahead and message us either on Twitter. My name is Cantor Clark. Or my partner, Josh Rager. Message us on Twitter or go ahead and message us on YouTube. Either way, we'll reach out to you. But if you see this first, feel free to drop us a line. All right, so that's it, guys. As always, it's been a pleasure. This is Ryan, aka Cantor Clark, and on behalf of my partner, Josh Rager, we want to thank you for tuning in to the BlockRoots YouTube. As always, exercise proper risk management and trade effectively.